Hello and welcome to today's video. This video looks at tax provisions that expire in 2025, the likely changes that will be made by Trump and his Republican colleagues, and the potential impact on businesses and individuals. Key provisions of the Tax Cuts and Jobs Act, TCJA, from 2017 are scheduled to expire on December 31, 2025. This presents a significant opportunity for Republicans, who are likely to control all three branches of government, to shape tax policy in a way that balances revenue needs, economic growth, and fairness. As the expiration date approaches, a Republican-led Congress will need to decide whether to let these provisions lapse, renew them, or introduce reforms. With a confirmed majority in the Senate and a likely majority in the House, Republicans will have the ability to pursue the tax changes they prefer. However, according to projections from the Congressional Budget Office, CBO, extending the TCJA without any offsets could add approximately $4.5 trillion to the deficit. This fiscal challenge will undoubtedly influence the debate over which expiring provisions to retain. TCJA Overview. Passed by a Republican-majority Congress in 2017, the TCJA was the most comprehensive tax overhaul in nearly 30 years. The legislation slashed the corporate tax rate from 35% to 21%, capped state and local tax, SALT, deductions at $10,000, doubled the standard deduction, expanded the child tax credit, and suspended personal exemptions. The $1.5 trillion bill was designed to stimulate economic growth, reduce regulatory burdens, and create a more favorable business environment in the U.S. The TCJA was passed as a reconciliation bill, meaning the bill overrode filibuster rules and only required a simple majority of 51 votes in the Senate. However, to comply with Senate budget rules and avoid increasing the federal deficit beyond a 10-year window or affecting Social Security, many provisions were made temporary. Corporate tax rate changes. The reduction of the corporate tax rate to 21% is one of the few TCJA provisions that does not expire. However, President-elect Trump has suggested lowering it even further to 15% for companies that manufacture their products in the U.S. Nonetheless, Republicans may face pressure to raise the corporate tax rate slightly during the 2025 negotiations to offset the revenue loss from extending other TCJA provisions, particularly those benefiting individual taxpayers. Key expiring corporate tax provisions. The potential expiration of the TCJA's corporate tax provisions poses significant implications for U.S. businesses. Several corporate tax provisions under the TCJA are set to expire in 2025, including pass-through income deduction. Sole proprietorships, partnerships, and S-corporations will lose the ability to deduct up to 20% of qualified business income, QBI, under Section 199A. Republicans argue this deduction is essential for leveling the playing field for small and mid-sized businesses. Industries like real estate and manufacturing, which heavily benefit from this deduction, are lobbying to extend it. Bonus depreciation. The current 100% bonus depreciation allowance for capital assets will phase down to 50% in 2025 and continue declining until it fully sunsets in 2027. R&D expense deduction. The TCJA requires businesses to amortize research and development expenses over 5 years rather than deducting them immediately. This change will persist beyond 2025 unless Congress modifies it. Bipartisan efforts are underway to restore immediate expensing for R&D costs. Business interest deduction. The TCJA tightened restrictions on expensing business interest. The tighter restrictions on the business interest deduction will revert to pre-TCJA rules, which generally allowed business interest expenses to be deducted in the year the interest was paid or accrued, with some limitations. Reverting to pre-TCJA levels will make it easier for companies to deduct interest expenses. Expiring individual tax provisions. Individual filers will see a rise in their income tax rates, a lower standard deduction, changes to itemized deductions, and a rollback of the child tax credit, if Congress allows the TCJA to sunset. Changes are as follows. Individual tax rates. Marginal tax rates will revert to pre-TCJA levels, with the top rate increasing from 37% to 39.6%. Republicans support lower marginal tax rates. Standard deduction. the TCJA nearly doubled the standard deduction for single and joint filers. This deduction will return to pre-2018 levels, adjusted for inflation. Personal exemptions, eliminated under the TCJA, will be restored in 2026, potentially reducing taxable income. The personal exemption would be about $5,275 in 2026 for each taxpayer. Mortgage interest. The mortgage interest deduction limit will revert to properties valued up to $1 million, up from $750,000 under the TCJA. Charitable donation deductions. The charitable contribution deduction limit will decrease from 60% to 50% of adjusted gross income, AGI. SALT deductions. The SALT deduction allows homeowners to deduct state and local taxes from their income. The TCJA limited the deduction to $10,000. Prior to the TCJA, there was no cap on SALT deductions. The $10,000 cap will no longer apply if the TCJA expires. Since 2018, lawmakers from high-tax states, such as California, New Jersey, and New York, have tried and failed to get rid of or raise the cap, reporting that their constituents were disproportionately affected. Estate and gift taxes exemptions will drop to around $5 million, adjusted for inflation, down from the current $13.6 million. Republicans view the estate tax as a death tax that punishes wealth accumulation, as in the case of farmers who want to pass on their land through inheritance, but their estate ends up needing to sell assets to cover the estate taxes. Democrats, on the other hand, view the estate and gift taxes as a means to address inequities, where high-income earners cannot pass on substantial fortunes or trusts without paying their fair share in taxes. Trump and the Republicans will likely try to extend this tax exemption and even increase the amount. Child tax credit. The credit will decrease from $2,000 to $1,000 per child. Income thresholds will decrease to $75,000 for individuals and $110,000 for married couples. Republicans, including Trump, have expressed support for maintaining or expanding the credit. How tax legislation is likely to play out. Given the expected Republican control, they may use reconciliation bills to extend key TCJA provisions without needing 60 votes in the Senate. This legislative maneuver could help pass extensions of TCJA tax cuts, expanded child tax credit, lower corporate tax rates, repeal of certain clean energy tax credits introduced by Democrats in 2022. While the exact details of future tax policy remain uncertain, it is likely that Republicans will aim to preserve the tax reductions implemented in the TCJA. Planning for the future. It's never too early to consider how potential changes to the tax code might affect your financial and business plans. Adjusting your planning and forecasting models to reflect these potential changes can help mitigate the impact of any upcoming tax reforms. Thank you for watching. Don't forget to like, share, and subscribe for more updates. And I will see you in the next video.